Let's keep it with banks for now. Recently, RBI, pretty much announced that the bank deposits that are made through online channels, banks would need to keep a higher liquidity buffer, and the gap between deposit and credit, the loans dispersed is already at a 20-year high. I mean, considering from what I understand, this particular move could further drive up the cost for banks, and because of which it could force banks to cut down their FD rates once again, which could exacerbate this entire problem of lack of deposit growth. What's your opinion over here, sir? Is RBI or the regulatory crackdown that we are seeing, is what impeding this growth in banks, or at least stocks in this segment to do well?
I think you're right. I think deposit growth rates would further get impacted, and I think the cost of raising funds will obviously increase in the in the short to medium term. And I think obviously once you need to make a bigger provision, that kind of liquidity will not be available for the banks. So I think the banks will have a challenge. I think most of the banks who have large CASA ratios also will obviously have to make these provisions. So I think net. Yes, banks are going to face a pretty challenging period. Either they cut down the FD rates, or possibly, they will have to recover this cost in some way from the customers. So I think net, both the PSU as well as private sector banks could get impacted. And I think, this could get reflected in maybe the September quarter numbers. The June quarter numbers may not show any, negativity on this front. But September quarter onwards, I think you'll see these kind of margins getting compressed to a marginal extent. Larger banks who have a large deposit base would obviously have to then reconsider whether they cut FD rates, or they obviously recover this cost via some other kind of method.